OPEC lowers oil demand forecast. So, why are investors returning to Nigeria? OPEC has lowered its global oil demand growth forecast for 2026. At the same time, we're seeing renewed investment momentum in Nigeria's oil and gas sector. New final investment decisions, growing activity from indigenous operators, deep water projects moving forward, gas projects gaining traction. So, here's the question. If future oil demand growth is slowing, why are investors still putting billions of dollars into oil and gas? And more importantly, what does this mean for companies operating in Nigeria? This is the Gas Gist with Chinano. Let's start with what OPEC actually said. Many people are reading the headline and immediately assuming that oil demand is failing. This is not what happened. This is not what OPEC is saying. OPEC is saying that the world will still consume more oil next year than it does today. The difference is that demand is expected to grow more slowly than previously forecast. And why? Primarily because of the ongoing Iran conflict and disruptions around the Strait of Hormuz. For investors, that changes the game. When demand growth slows, capital becomes more selective. Investors stop asking, where can I find oil? And start asking, which projects can make more money consistently? That distinction is important because it explains exactly why Nigeria is suddenly attracting renewed interest. Nigeria is benefiting from three developments happening at the same time. First, the Petroleum Industry Act has improved regulatory certainty. Second, indigenous operators have matured significantly. And third, global energy security concerns have reminded investors that oil and gas are not disappearing anytime soon. The result? Nigeria is no longer competing simply on reserves. We're now competing on commercial opportunity, and that has implications for every player in the industry. Listen, for Nigerian independent operators like Seplat, Renaissance, Heirs Energies, First E&P, Oando, the acquisition phase is largely over. The market is no longer impressed by who bought which assets. Investors want to see production growth. They want to see lower lifting costs, reserve replacement, gas monetization, cash flow. The question is no longer, can you acquire the asset? Like I said in my last episode, the question is, what can you do with it? For EPC companies, come closer. This environment creates both pressure and opportunity. Projects will still move forward, but operators will demand lower capex, faster delivery schedules, and stronger project controls. The EPCs that thrive over the next decade will not necessarily be the biggest. They'll be the ones that can consistently deliver projects on budget and on schedule. And increasingly, those opportunities will be concentrated around gas processing facilities, compression stations, pipelines, energy infrastructure, CNG projects, and gas-to-power developments. Don't say I didn't do anything for you. As for the international oil companies, this forecast changes very little because the majors saw this coming years ago. And that is why companies like Shell, Total Energies, ExxonMobil, and Eni have increasingly focused on LNG, gas, and high marginal deep water projects. They're not chasing the largest volumes, they're chasing the most profitable barrels. For marginal field operators, this may be the most important signal of all. Access to financing is becoming more competitive, and investors are scrutinizing project economics more closely. Fields with high operating costs, weak evacuation plans, or no gas monetization strategy will struggle to attract capital. The operators that will succeed will be those that achieve first oil and first gas quickly, maintain low operating costs, and find ways to commercialize associated gas rather than just flaring it. And that brings us to what I believe is the biggest takeaway from the story. The OPEC forecast is not a warning that oil is disappearing. It is a warning that easy growth is disappearing. And whenever growth becomes harder to find, capital flows towards efficiency, execution, and value creation. That's why gas keeps showing up in every serious industry conversation. Ano, AKK, NLNG Train 7, OB3. These are not side projects. They are increasingly becoming the center of Nigeria's long-term energy strategy. My gas take? The renewed investor interest in Nigeria and OPEC's revised demand forecast are not contradictory stories. They are actually telling us the same thing, which is that the market is becoming more selective. The future winners will not necessarily be the companies with the biggest reserves. They'll be the companies that can produce efficiently, execute projects successfully, commercialize gas effectively, and generate sustainable returns. The era of asset acquisition is gradually giving way to the era of value creation. And for Nigeria's energy industry, that may be the most important shift of all. And that's the gist.